Thanks for signing up for a free trial of Portfolio Builder's income platform. Here's what to expect during your free trial. The #1 income strategy for retirement. Every Monday, I'll be sending you a weekly income generating trade alert. For every $100,000 in your portfolio, this trade alert can be expected to generate between $350 and $700 a week of income. Now, if you're starting with less than $100,000, it's important to know that you can still use the platform with as little as $1,000. You just won't be able to participate in the option writing portion of our strategy until your account size reaches at least $25,000. For most of you, your first goal should be to reach a minimum portfolio size of $250,000, which can consistently generate a weekly income ranging between $875 and $1,750 per week. If you're not there yet, it's not a problem. Simply reinvest your profits until you are. Now, I know $875 to $1,750 a week of income may sound like a very wide range. And that's because the smart way to generate income isn't to force returns out of the market. It's to take the best return with the least risk at all times. In general, you'll see the model portfolio only sell option premium when volatility is high and option prices are steep. When volatility is subdued and options are cheap, usually the model portfolio will simply let the underlying equities appreciate on their own with no option selling. This natural rise and fall of volatility in the stock market is as common as the ocean's tide. So it's important that you budget around an income source that will consistently fluctuate as well. Let's talk about the risks to this strategy before we get into the mechanics of how you'll generate weekly income from your underlying assets managed by the Portfolio Builder platform. Death, taxes, and stock market crashes, the only sure things in life, right? If our portfolio's underlying asset, which is a globally diversified portfolio of the world's most profitable companies, encompassing the 7 superpowers of the world, including the USA, China, Japan, UK, Germany, Brazil, and India, were to suddenly drop in value by 50%, our strategy's income would also drop by half. That's why you should never use this strategy on any single stock, no matter how much you love the company and believe in its future. Doing this would expose your portfolio to extreme levels of specific business risk. It might be tempting to get greater weekly returns from a quote-unquote hot stock compared to the returns we're making on index ETF funds. But just don't forget this: a fool and his money are soon parted. Portfolio Builder doesn't want the greatest return, it wants the best risk to reward ratio. Or in other words, the smartest return. That's why it makes no sense to bet your entire retirement on a small group of companies, since you can just as easily buy 7 ETF country index funds and spread your risk amongst hundreds of corporations. It also makes no sense to bet all of your money on a single country. Most of you watching this are quite likely concentrated in US equities, which have performed great over most of your lifetime. Investing in America has been a great play since World War I and World War II, when the rest of the world blew themselves to pieces and then set themselves back by decades. This gave America an unfair advantage over the past century. But now the tables have turned. America has become inefficient and is piling on debt at a rapid pace, while its hungrier and more motivated peers are growing at light speed by comparison. And this series of visualizations will graphically demonstrate just how fast the rest of the world is catching up. In 1960, the US GDP was 40% of the world's economy. Germany, UK, France, China were all much smaller. By 1970, the tides began changing. The US lost the 40% dominance and dropped to 36%. By 1981, the tides had changed even more, and now Japan was rapidly gaining market share in the world economy. By 1990, America's GDP percentage of the world would drop to 27%, as Japan's expanded to 14%. By 2000, China enters the scene in a serious way. By 2000, America has gained a slight amount of its GDP, jumping to 31%, as Japan expands to 15%. But then China exponentially grows over the next decade, reaching 15% for China, 6% for Japan, and smushing the US GDP down to 24%. And now, today, America is still hanging on to 24% of the world GDP, as China's GDP expanded to 14.8%. And meanwhile, the global reserve currency, which has been the dollar over the past 94 years, may be coming to an end. And as we look at the global reserve currencies since 1450, we can see this is a regular trend for a country to dominate for anywhere from 80 to 110 years, starting with Portugal, then Spain, then the Netherlands, then France, then Britain. How long can the dollar remain the world currency global reserve? By simply looking at the previous year's GDP per superpower country, we can roughly predict the next year's GDP, which tells us how much of the profit each country will control in future years relative to all other countries. And this is how Portfolio Builder determines what portion of its stock portfolio should hold each country's index ETF fund. Here's the current breakdown for 2019 in a purely stock portfolio. United States 28%, China 17.8%, Japan 7%, Germany 5.4%, United Kingdom 3.8%, Brazil 3%, India 3.8%, leaving a 20% position split between cash and gold. It's important to note that Portfolio Builder still has its largest exposure to the big names held in America through the SPY ETF, such as Google, Apple, or Amazon, with its 28% allocation size. However, it also has exposure to every publicly traded company in the 7 strongest superpowers of the world. This makes our portfolio management extremely diversified and gives us confidence to hold these positions for the rest of our lives. Now, does global diversification protect us against a systematic global financial crisis? No. However, if you're willing to reduce your weekly income by around 33%, you can greatly reduce your portfolio's volatility and potential drawdown by holding a large position in the TLT ETF, which is a fund holding 20-year Treasury bonds. And if we compare the SPY to the TLT, we can see that there's much more potential growth in the SPY, but there's also much greater volatility. By putting a large portion of our portfolio in the TLT, which has much smaller fluctuations in value, we can reduce the volatility of our weekly income. The assets held in the TLT are backed by the US government, and it is the single safest place to park your wealth for the next several decades. The downside is that the return we can make from selling weekly option premium against the TLT is often half that of the SPY and even a third of other country ETFs. But typically, when bonds go up, equities go down and vice versa, helping reduce portfolio volatility. The following portfolio allocation, coupled with weekly income option writing, makes an extremely powerful retirement income generating machine, especially for those of you with well over $250,000 to put to work. Now, the TLT position represents 40% of our total portfolio. The United States SPY 16.4, Japan 4, Germany 3, UK 2, Brazil 1.7, China 10, India 2, gold 10, and cash or digital money 10%. With this rock solid underlying asset, we can now write covered calls to generate weekly income for the rest of our lives. Which brings us to risk number 2. Volatility has a huge effect on the short-term income we're able to generate. This will cause a dramatic fluctuation in the weekly income we're generating from selling option premium against our underlying asset. Here's a look at the past 5 years of U.S. stock market volatility. The higher the VIX, the greater amount of volatility and thus the higher prices of options. This is one reason why Portfolio Builder has a 10% designated cash position, so that during periods of low equity growth and low volatility, you won't be forced to sell your equities in order to maintain your current income needs. Risk number 3. Portfolio Builder systematically purchases and maintains a financial crisis hedge through the purchase of out-of-the-money put options against each underlying ETF. These put options can return 5,000 to 10,000% in the event of a 30 to 50% market decline over a period of 18 months or less from the time of purchasing the option contract. By reinvesting a portion of our weekly income, this allows us to maintain a 1 to 3% portfolio exposure to such option contracts and protect our underlying asset from a violent stock market crash on any given ETF we're holding. If the market were to crash 50% in less than 16 months from purchasing crash insurance and your portfolio had just a 1% portfolio allocation to this, it could completely insulate your portfolio from experiencing any loss of value. And holding a 2 to 3% position in this asset during a violent financial crisis could potentially double or triple your total portfolio value. If, on the other hand, the underlying asset does not drop in value fast enough, these put options may result in a 100% loss on all capital invested into these put options and provide no protection to your total portfolio. By diversifying your portfolio into half equities and half U.S. Treasury bonds through the TLT ETF, you can help normalize the amount of weekly income your portfolio can generate and reduce volatility in your portfolio's value. And once again, we can compare the SPY, greater volatility, greater return, while the TLT can generate consistent returns and help reduce volatility. Risk number 4, Portfolio Builder's default setting provides a 10% allocation to the GLD Gold ETF. Gold, in general, is an investment to protect against inflation, which has been hard to find over the past decade despite massive monetary stimulus from central banks, except for in the prices of stocks and real estate. We're now potentially entering a decade of tighter monetary conditions, which may potentially have negative effects on equity prices without causing a spike in gold prices, and even potentially causing a drop in gold prices. Here's a chart of gold over the past 4 years, which has crashed from $152 down to $117. Without inflationary fears, gold may be stuck at current price ranges or go lower, and by exposing 10% of our portfolio to this asset, it also exposes your portfolio to additional losses. This is not my expectation, however, as over the past decade, central banks have been net buyers of gold. And as we can see, since 2011, central banks continue gobbling up gold. A 100-year chart of gold gives you a better idea of how volatile this asset has been. However, the key factor that tells me this is a smart asset to hold is the sheer amount of capital flooding into gold. Down below, we can see the trading volume ramping up, and over the past 100 years, a wild ride in gold prices through the booms and busts of capitalism and experiments with monetary policy. Its price, however, has gone up in general over the past century, as the monetary supply has also dramatically increased. I expect this portion of our portfolio may very well carry drawdown until inflationary fears create a gold buying panic from a global audience of investors. However, with the sheer amount of debt piling on at record pace around the world, there's plenty of fundamental reasons to hold a 10% position in gold for the long term. And here's the U.S. debt clock amongst all the other countries and their amounts of national debt. And this trend is continuing to grow and grow as governments are addicted to debt. Risk number 5, Portfolio Builder has a bonus digital money asset feature, which, if you're looking for exponential potential portfolio growth, can be obtained through currencies such as Bitcoin, Ethereum, and other top traded cryptocurrencies. If we look at Bitcoin's price over the past decade, it started at 10 cents, jumped to $1, then to $10, then to $100, then to $1,000, up to $2,000 in 2017, jumping up to $20,000 by 2018. And of recording this video is currently back at the $3,500 range. They call it digital gold, and as such, this digital money has risen in value by over 3 million% at its peak since the conception in 2009. This portion of our portfolio should only be used with a portion of your cash position. While many digital money enthusiasts love to analyze the growth of Bitcoin and its quite frequent crashes and rebounds over the past decade, most fail to grasp the change of economic environment we're now entering in 2019 and beyond. Digital money to date has only lived through an inflationary environment where central banks collaboratively printed trillions of dollars and gave banks money to invest at 0% interest rates. Now the exact opposite is true, as they are collaboratively raising interest rates and reducing the amount of money in circulation. The next rush into digital gold could potentially be put on hold until the economy is once again in an inflationary environment. And if we look at the chart of Bitcoin, we can see there's a lot of buyers during this collapse from 20,000 to 3,500. And despite being down 80% from its 2017 high, money continues to flood into this asset at record-breaking levels, and we encourage investors to use a portion of their cash position to invest into these assets. In our model portfolio, we continue to maintain a position representing 5 to 7.5% of the total portfolio assets, or between 50 to 75% of our cash position. Sitting at a market cap of $100 billion, it wouldn't take very much money spilling out of the combined $100 trillion bond and stock market to make this sector grow exponentially in a very short time period. Let's take a look at Portfolio Builder now in action. So here we are looking at the home screen of the Portfolio Income platform, which covers stocks, bonds, options, gold, and digital money. In this video, today's date is 12/18/2018, and we've just released the new platform and have issued the first 6 days of trade alerts and updates, which we will review day by day. But first, let me give you a quick tour of the platform so you can see its features. And to do so, I'm going to zoom in so you get a clear view of the screen. So what we're looking at now is in the top, we have a summary of our positions, our returns, our deposits, our withdrawals, which we call income, the value of each asset class, and then a breakdown of our asset classes. So if we look over here in this area in the middle, we can see the target position for each ETF. And in this example, I have a 40% position in the TLT as my target, but right now I only have a 35% actual position. I have a 10% target position in gold and have an accurate portfolio percentage currently. You'll note my India position is less than the target, and that's because it's waiting to get filled currently. We have a 10% position in China, a 1.8 in Brazil, 2.3 in the UK, a 3.3 in Germany, a 4.4 in Japan, and a 17% in the United States. But this can quickly change, and if I didn't want to be so conservative with my returns, I might put the bonds at 0% and push my stock holding to 80. And now you can see it's going to issue some trade alerts. It's going to say I need to purchase another $161,000 worth of stock, and I need to sell $143,000 worth of bonds, and also sell $15,000 worth of cash. So if we come over here now, we can see my target size for the SPY ETF has jumped to 32%. And because my actual percentage is only 17, this is going to issue a trade alert to purchase 245 shares of SPY. So if the stock market had just crashed 50 or 60%, this might be a smart asset allocation. As it stands going into 2019, we're at the opposite spectrum where we still want to generate some great returns from stocks, but we want to insulate the value of our portfolio with a safety cushion holding the bonds. Now if we scroll over to the right, we can see our withdrawals and deposits. Withdrawals represent taking cash out of your portfolio for your income needs, while deposits represent money you're adding to your portfolio to be managed in our platform. And you can say in this hypothetical portfolio, we deposited $400,000 in December. And if we scroll back to the main home page, we can see what our current trade alerts represent. If we scroll down, we can see all of our buying and selling of these ETFs, which is where we record the buying and selling of our underlying assets. If I scroll over to the right, here's where the weekly income is coming from. Every Monday, we issue a new trade alert to write a covered call against our underlying ETF positions. And that's when volatility is relatively high on the underlying asset. When the volatility is low, we let the underlying asset appreciate on its own. Our strategy only allows you to have one open option writing position per ETF at a time. And for every 100 shares of each ETF you own, you can write one covered call. In these dark shaded areas, this is where we insert our data to track each trade, and the light shaded cells are actually automatically filled in for you. Here's the current credit we are receiving this week, and this Friday all of these options will expire and we'll get to enter into a new contract the following week. Down below, each week we move the open trades to the closed trade, and that allows us to open a new trade. This is where we track all of our previous trades. And so we can see the income generated last week, whether the option was assigned or expired, and even the contract name, which allows us to have a real-time quote of the value of each option. And of course, we want these to go to 0 at the end of each week so that we collect the full premium with no work. Now if we scroll over to the right even further, we have open option buying and closed option buying. This is where we're primarily at the end of a market cycle buying out of the money put options. Right now volatility is high, so we have not entered into any of these trades just yet. Here's what a sample trade alert might look like each Monday. So the first step is you have to build the underlying assets from first putting a deposit and then purchasing the right amount of each ETF. And again, this is displayed to you at all times in the home page screen right in column E, with the trade alert tells you how many to buy or sell to reach the target percentage of each ETF. Then on Mondays you'll receive a trade alert to generate income from writing a covered call. This is the most simple, safest, and consistent way to generate an income through the stock market. And in this case, I'm selling to open two December 14, 2018, $262.50 strike call options for a mid price of $3.12 per share. Every contract represents 100 shares, so that's $624. Now in the next tutorial video, we'll get into the details and nitty-gritty details of how options work and how to fill in the platform. In this video, our goal is to give you a general idea of how the platform works, what to expect, and what your week-to-week job will be to maintain your portfolio and generate the weekly income. Here was the trade alert for Japan, EWJ, 3 contracts. Same deal. This trade alert generated $63 this week. Germany, EWG, 5 contracts. This trade alert generated $125 this week. EWU generated $90 this week. Brazil, $120 with 2 contracts. And China for $440. India, $90. And our GLD position, 76. Here's the trade alert summary, and you can see we generated anywhere from as little as 0.3% to as high as 1.59% on our underlying assets in this sample trade alert in a single week. Now in this week, we got lucky, an extra $500 to collect today. And in this trade alert, the SPY ETF jumped in price right after we had written it, which means we were assigned the stock. So we got to keep all the profit from the previous day, and then we decided to re-enter the position. So because now we were sitting on a lot of capital, cash that had been acquired through the sale of our SPY shares, we now wanted to re-enter the market. So in this trade, we sell to open 2 December 14th, 2018, $267 put option contracts. And this means we're now on the hook to buy our SPY position back if the SPY drops to below the strike price plus below the price we paid for the option contract. So in this case, it has to go $2.70 below $267.50. If it does that, we get to keep the $269 times 2, plus we get to purchase the SPY position which we want to re-enter into. If the SPY trades above that, we create the return and never have to buy the position, re-enter the same trade the following week. And in the first week of launching this, lo and behold, after writing that, we did get filled the very next day. So then we went right on to selling another covered call expiring in 3 days for a $183 per contract times 2. $366 for 3 days of trading. And so that's the name of the game. To get filled into positions, we write put options. This gives us a discount to re-enter the market. And once we have a position, we sell the covered call to generate income against our underlying asset. When volatility is high, we sell the expensive option premium, and when volatility is low, we let the underlying assets appreciate on their own. And even though we haven't been able to do this since launching the Portfolio Builder Income platform, when volatility is low, we will also invest in leap options to protect against financial crises hitting each country. And that is managed in this yellow and purple section. So thanks for your time on this getting started video. In the next video, we're going to start learning a lot more about options, about how to input all of your trades into the spreadsheet, and get into the nitty-gritty details of how to use the product.